Good afternoon, everybody, and welcome to the Fat Profits Macro Webinar. Patrick Ganley and Angus Geddes. Angus, how are you today?
Very well, thanks, Patrick. How are you going?
I'm good. So here's our two presenters. There's Angus and myself, as usual. A little bit of housekeeping before we get started. Please be reminded that all the information presented today is on a general advice basis. Before acting on any of the recommendations, please be sure to consult with a financial planner or advisor. And please be reminded that past performance is no indicator of future performance. You'll have the opportunity to type in some questions, and Angus and I will endeavor to get through as many of those questions as we can. You can type the questions in here with the orange arrow. If you're having trouble listening to the presentation today, a couple health checks: check the volume on your PC, check the speakers are plugged in, check your headphones, check the sound settings. If you're still having problems, please call the office 1-300-88-1177. So without any further ado, market update. Angus, it's been an interesting time on the markets recently, and we thought we'd start with this these U.S. bond yields, which are moving aggressively higher.
Yeah, I think, since that outsized sort of rate cut that the Fed put in about 4 or 5 weeks ago at the last FOMC meeting, the narrative has changed around the future path of expected rate cuts in the US. Simply, what's basically happened is inflation has been coming down, but the jobs market has been really very, very strong and quite resilient. And we haven't really sort of seen any deterioration over there. And of course, that was what the Fed was worried about when they put that 50-point cut in, because, back then the debate was very much, is the Fed falling behind the curve? Are they going to start turning the ship before it's too late and easing? And, that very strong labour market has pushed back on that rate cut narrative. I should also point out that it's been a very similar story here in Australia. You'll recall, Pat, that I had quite a high conviction view that the RBA would be cutting by the end of the year because inflation was coming down, the economy was slowing. But then, you look at the labour market here and the very strong new jobs that are being added, albeit all in the public sector. It's not the private sector that's doing the hiring, it's the public sector. It's really, within government services. That potentially pushes the rate cut narrative out. So yeah, in essence, we've seen the bond market really back up in terms of yield. That's hit, the 10-year yield has hit 4.2%. And whilst I think, we'll probably see the bond market stabilise around these levels, we've got to keep a very close eye on that big primary downtrend, because if that were to be broken on the upside, if the 10-year yield were to climb above 4.4%, I don't think that would go down too well in the markets, and it would mean that there's something seriously wrong with the Fed, commencing a new easing cycle. So yeah, we just got to keep an eye on it. And we might see a bit of consolidation now, but we really don't want to see, this is in the near term, that 10-year Treasury yield breaking out above that primary downtrend. Now, this is really a near-term view, and I still think the stage is set for a decent rally into the end of the year. We can look at a lot of other charts, but we've got to keep an eye on this because, a secular bear market in bonds means that the long end of the US yield curve is going higher, not lower. And that does have implications for the broader markets. But my base case is that we're not going to see the US 10-year break above that primary downtrend trend this side of Christmas, but we need to keep an eye on it. My medium to longer term view is that bonds are in a secular bear market, and before this bear secular bear cycle finishes. We're going to see much higher bond yields, and really sort of see them getting back to where they've historically been on average, over the last, sort of 50, 60, 70 odd years, which is, it's in that 5 to 6% range. It's not 3.5 to 4%. It's 5 to 6%. So there we have it. That's the bond market.
And do you think this is one of the reasons why we saw a bit of a sell-off in the market in the States yesterday?
Yeah, I think the stock market, gold, precious metals, commodities has actually been quite resilient, and we've seen a fairly muted reaction in the dollar to those rising bond yields, but I think it finally sort of caught up on Wednesday. Arguably, the US S&P 500, which has been hitting record highs at the top end of that channel, was really looking for an excuse for a bit of a corrective sell-off. It's hitting resistance now at the top end of that channel, and so it wouldn't surprise me between now and the election, if we saw a bit of a correction and the S&P 500 retreat away from those record highs. The base case that we're still running with is that we'll still get a strong finish into the end of the year, a strong rally once the US election's out of the way. I don't think there's any risk yet to this bull market. And I put this chart up today because I just wanted to highlight the big bull market between the pandemic lows of 2020 and when it topped out in early 2022. We saw a huge move in the S&P. It went from sort of 2,200, which was the low in March 2020, up to 4,800. So a huge move. And then we saw a cyclical bear market that endured for about just a bit over a year. There's no danger to this current bull market as yet. It's still remaining, well within the confines of that trend channel. And, all things being equal, our base cases for the bull market in US equities and indeed international equities to continue into next year. If we saw the S&P 500 break down below the bottom of that trend channel, that big support level, just below 5,600, I would be more worried. Just as it did that in early 2022, and albeit when it broke the channel, it actually retested the top of the channel, which became resistance on 2 occasions. I'd be more worried, but we're not even within close proximity to that sort of technical development happening. So this sort of says to me that the bull market has got sort of near-term corrective risks, but it's very much intact, and we're looking for quite a strong finish into the end of the year, and indeed quite a strong run next year, and for further upside extension within this channel.
I just wanted to ask you that the small caps got spanked overnight as well, with the Russell 2000 dropping quite a bit, but the growth stocks were the hardest hit. Do you think the large caps are a bit overvalued at the moment?
Yeah, I do. I think look, the large caps are more sensitive to those higher bond yields in terms of their valuations. You put in a higher discount rate and into a equity valuation model, and it will bring the number down. So there is some sensitivity, but I also think the small mid caps are proven to be quite resilient because there's just no sign of recession out there. Economic conditions remain very strong in the United States, and for this reason, the bond market's not so much flashing a red light at the moment. It's not flashing a red light about the economy deteriorating. It's more that the economy is too strong, and the Fed might have jumped the gun in terms of putting that outsized rate cut in, and that the path of easing over the next 12 months is not the sort of 175 basis points that we were looking for back in August, with a terminal rate of about 2.8% on the Fed funds. you know, we're probably going to see, you know, less than half that in terms of easing. In fact, that's kind of what the bond market and the interest rate futures markets are sort of telling us at the moment. So that yeah, instead of 4 cuts next year and 2 before Christmas, you know what? It might only be 3 cuts, three cuts or 4 cuts, and that might play out over the next sort of you know, 12 or 18 months.
And we saw the US dollar rise overnight. What did you
So
make of that?
the dollar has rebounded, and I did allude to this, that when the dollar index touched that 100 level, which is quite a big support, formidable support level, that the upside risks of a near-term rebound were high, and we have seen that. And of course, you know, the US dollar index has been running on the back of rising interest rate differentials, which now are swinging back to favour US, less rate cuts coming, higher bond yields. You know, in terms of US capital markets, you know, they're now yielding more and are likely to yield more over the near term. At least that's the way the markets are seeing it optically. And of course, this has fueled a rally in the greenback. But it's worth pointing out that, you know, the last time we saw US bond yields, you know, 10.25%, sorry, 4.25%, you know, the dollar index was a lot higher. So this sort of says to me that the greenback is losing a bit of momentum here. And, you know, it was a one-way bet between 21 and 22. I think it's no longer a one-way bet. And I think the risks are now skewed to the downside. But look, near term, those rising interest rate differentials are in the US's favour. You know, we're likely to see that remaining a tailwind for the time being for the US dollar. But I think, you know, next year we're going to be sort of becoming more aware. I think markets are going to be becoming more aware and more focused on some of the structural deficiencies of the greenback. And I wrote a lot about that today, you know, the de-dollarization thing that's sort of taking off, and how countries are trading with one another outside the US dollar system.
Okay, I thought we'd jump over here to Australia and the ASX 200 breaking out above the top of the long-established trend. Do you see this continuing to develop?
Well, look, we need more sustained follow-through price action. I wouldn't be surprised if, you know, the ASX 200, you know, has a bit of a moderate correction over the next couple of weeks, you know, around the same time as the US election. You know, the tail doesn't wag the dog wags the tail. It's a bit like that with the US markets. What the US markets do moves the rest of the world. It's not the other way around. So yeah, look, I think it remains to be seen whether the ASX 200 can hold above the top of this channel. But, you know, the technical setup is pretty bullish. And since taking out that big resistance level at 7,500, you know, we've seen the ASX 200 march higher to hit sort of, you know, 8,300 recently. And what has been quite a decent rally. I think support is very significant at that 7,500 level. And I think, you know, we're in a bull market, despite, you know, the monetary policy being pretty tight, and, you know, consumer spending being in a bit of a funk at the moment. You know, the stock market is marching to the beat of its own drum. And I think, you know, next year we will see rate cuts. We're going to see some, you know, a decent amount of easing coming through from the RBA, particularly if the upcoming CPI number confirms that disinflationary trend, which I believe it will. And, you know, I think there's a lot to be excited about. Now, some fund managers and some commentators are worried about the valuation of the ASX. And it is true that, you know, the PE is looking quite high, but there's a lot of sectors in our stock market that have lagged, such as the discretionary retailers, which could run pretty hard next year if the RBA starts cutting rates and taking that pressure off consumer balance sheets. I think we could see further significant upside extension in the resources sector, particularly, if Beijing goes again on more stimulus measures, which is my base case. That could also provide a lot of lift for the market. We're seeing the gold stocks as a subsector in the materials index really outperform finally after being a laggard for such a long time. So yeah, there's lots of different drivers that could take the ASX higher next year, and I wouldn't be surprised if we saw the ASX 200 hit 9,000 next year. I know UBS have got a target of 8.5, but I'm a bit more aggressive. And if we look at this chart, technically it's taken the ASX the better part of 13, 14 years, really even 16 years to comfortably get above 7,000. We've had a couple of really good retests of that 7,000 support level along the way. The bull market is now climbing a wall of worry. So, big period of overextension in our market between 2000 and 2008, when that was really the last time we had a roaring runaway bull market. And I think, we're going into one of those over the next 5 to 10 years. And, I think the next several years are going to be pretty good for the domestic stock market.
Okay, well, this was an interesting chart as well, the FTSE 250.
Yeah, I thought I'd sort of bring this up because, whilst the Australian stock market is skewing to the expensive side at the moment, the FTSE 100 is most definitely not. And it's priced at around 10 or 11 times one of the cheaper stock markets. The FTSE 250, I thought the technical setup here looks pretty good. We can see the index sort of in this quite well-defined trend channel, particularly on the top side. Every time the FTSE 200 has hit the top of the channel, it's corrected. And the last time it did that was in 2021. The interesting thing is the bottom of the trend channel has been respected, and we've now sort of seen, this year the FTSE 250 really sort of break out above that 20,000 resistance level. So yeah, I think this is one market or one benchmark that can do really well. We're quite bullish on we're bullish on Hong Kong, China stocks next year, and bullish on Japan again next year, and I'm bullish on Australia. But I think this next year could be the year that the FTSE 100 and the FTSE 250 really play a lot of catch-up, significant catch-up to the rest of the world. And bull markets climb a wall of worry. I think we're going to see this play out next year. UK companies really are cheap, and that's not just the large cap level, but also at the small mid cap.
And you touched on Japan. The yields around the world are rising, including in Japan. How do you see Japan playing out?
Well, I think bonds are in a secular bear market, and bond yields are going to move higher over the medium to longer term. What's interesting about this chart of the JGB yield is that hit nearly 1% this week, and that upward trend in Japanese bond yields is reasserting. So this is great for the financials in Japan. They are positively correlated to the JGB bond yield, and after having sort of to deal with zero interest rates for nearly 2 decades, a lot of those Japanese banks are seeing their margins expand. Why do I like the Japanese banks compared to Australian banks or UK banks? I like the Aussie banks, but I do think they're getting expensive. I think the US banks are all right as well. They'll probably do quite well next year, and also the British banks. I think better days lie ahead for them. But I still like Japan's banks because they're positively correlated to what is now a rising 10-year JGB yield. After being financially repressed for decades, their margins, their net interest margins, are expanding. They've got very strong balance sheets, very low risk of loan defaults and credit defaults. And obviously, there's no sign of a housing bubble in Japan. And they've got plenty of room on their balance sheets for buybacks. So, if anything, we should see the Japanese banks reassert to the top side.
I know we'll talk about a few stocks a little bit later in the presentation that relate to that. And here's one that we'll start with, which is in Japan.
Yeah, so Sumitomo Mitsui Financial Group is one of the largest positions we hold in the Fat Profits Global Contrarian Fund. I mean, that's obviously been disclosed to the stock exchange. We also hold this bank in our international SMA portfolios. And, we can see this nice, consistent uptrend in Sumitomo Mitsui. We saw the big sell-off occur back in August, and the stock bounced straight back above its primary uptrend. We've seen it do a little bit of work and retest that primary uptrend. It's putting in the first step above the base of that after that recent correction, and it's reasserting to the top side. So I think with those JGB bond yields heading higher, JGB bond yields are correlated, and now showing more correlation with US bond yields. I think given the correlation of, obviously the Japanese banks to JGB yields, we're going to see them resume an upward trajectory. And, my base case for Sumitomo Mitsui is that it will be pretty much close to retesting the record high, those highs above 3,700 yen by this time next year. That's our sort of base case for this one.
Okay, how about we talk a little bit about the Hang Seng? And I know we've been talking about this quite a bit, and I know you like this this market.
I wrote about this morning, and following that explosive breakout back in September, we saw the Hang Seng surge. I think it was 20 or 30% up to 23,000. We've had this big reversal. The media, full of negative rhetoric, sentiment's still very bearish. The business media will give you 10 reasons to not own these markets, and maybe one reason to own it. So we've still got very sort of pervasive negative sentiment, which is always a good sign, because bull markets, when they're born, they don't come and you don't get these big inflections into a bull market on euphoria. It's typically greeted with a lot of skepticism and doubt. So I would have to say that's pretty much characterizes where we're at today with Hong Kong, China shares. There's a lot of people that just don't doubt, that have huge doubts about this bull market. In fact, a lot of people still believe that China, Hong Kong are actually in bear markets. It's been our view for a while that the Hang Seng left a bear market, is now in a new bull market. The most recent advance up to 23,000 and corrective pullback to 20,000 is exactly what you would expect. You'd expect a decent correction of that advance, but I think now's the time to be accumulating and adding to positions and select Hong Kong, China shares. What we see in front of us here today, Pat, is a pendant formation. Pendants are really good because it basically says that the correction has halted. The market is that index is now sort of calling up within a pendant. The ranges are becoming narrower. We're seeing a series of higher reaction lows, albeit some lower highs as well. So the ranges are becoming more narrower, but volatility is beginning to settle down. And this is typically defines a continuation pattern. So, within a primary trend, you get a pendant. It's a consolidation, it's a pause. Typically, you'll get a topside breakout and a resumption of upward momentum. That's our base case for Hong Kong, for the Hang Seng index. So, I'll continue to watch this, but I'd expect within a couple of weeks, a matter of weeks, for the Hang Seng to resume an upward advance. And it's encouraging that big support level has successfully held up.
Well, here's one of the stocks I know you really like in Hong Kong at the moment.
Yeah, Meituan's one of the big major China technology platforms. It's the leading dominant technology platform in food delivery in China. So, we've had this in our portfolio for some time. What's interesting about this chart is that, again, like the Hang Seng, we've got this pendant following the corrective reversal. Meituan, when it broke out, nearly surged sort of 80% to hit, highs above 210, 220. And then it's corrected back to 170, and we've seen a topside breakout this week. So this is a continuation pattern. I'd expect Meituan to head back towards those highs in coming weeks and months, and indeed probably go a lot further. I'm finding that Meituan is beginning to lead some of those other larger technology companies, all of which, by the way, are looking technically pretty good. Your Alibabas, your Tencent Holdings, your Yum Chinas. I think they're all looking pretty good. But this is bullish, and I expect the Hang Seng index to complete a similar pattern in coming weeks.
Okay, gold's something we've been talking about a lot, and I know gold's hit some all-time highs. And how do you see this playing out now with where we're at?
I think the Australian market has finally woken up to the fact that at 4,100 Aussie dollars an ounce, it's a license for the Australian gold producers to print a lot of cash. That's the bottom line. And we know that a lot of the gold stocks are not even at the highs they were at back in 2020, when the US dollar spot gold price was at about 2,000. Now we're nearly $1,000 higher, and some of them are still no longer near their highs. So it sort of says to me that the rally has a long way to go. What I like about this chart is it's taken the All Ords Gold Index. It's taken that index the better part of 15 years to break out above convincingly above those historical highs at around 9,000. So the count out of the range now is for upside extension. I'd be looking for at least 12, 13, 14,000 on this index over the next year. So I think there's a lot of catch up. I'm encouraged by the fact that the sector as an asset class, not as an asset class, but the sector is under-owned in most investor portfolios. And I'm not just talking retail, but also at the institutional level. A great friend of mine runs one of the largest gold funds in the world. They've had outflows from their fund, their flagship fund, all year, which have only recently swung around to turning positive. We've seen exactly the same situation occur in a lot of the exchange traded funds. And that says to me that there's a lot of money that can now flow into the sector. So, whilst some people will probably be tempted to get out and take profits, with the All Ords at the record highs, my argument would be that the journey to get there and sustain that advance above those historic highs has taken the better part of 15 years. And we're in a new bull market as it relates to the sector. So, I would be staying in there definitely for the medium to longer term, and letting the profits run.
It seems quite interesting. We're seeing the US dollar move up and gold move up. Do you think that correlation's still there with, if the US dollar is coming off, the gold price is going to head higher?
We might put up the next chart. I've got a couple of charts which I'll talk to. Yeah, so if you look at the gold price in US dollars, it's defied gravity, and I wrote about that this morning. It's defied gravity. It's defied a stronger dollar this year. It's defied outflows from physical ETFs. It's physical gold ETFs. There's been outflows all year. Some of the central banks, like China, have markedly slowed down on their purchases. So a lot of people are sort of scratching their heads as to why gold has been able to break down these historical correlations. The other big one is, the big move in the bond market. In the last 4 or 5 weeks since the Fed cut, the 10-year has surged nearly 65, 75 basis points. Typically, you'd see, the dollar would be higher, and we have seen the dollar move higher, but you'd see the dollar probably a lot higher, and you'd see, gold come in for a lot of weakness. We just haven't seen that. That says to me that deep pockets are accumulating physical gold, and probably not for the obvious reasons that the media and the media are telling us that it's due to the Middle East. I mean, sure, I think that's part of the mix. I think the fact that people are concerned about geopolitics and that is part of the mix. But I think there's deep-seated reasons for this. And if I had to make a call, over the next several years as to what's really causing this, I think it's two things. I think one, the US dollar is not what it was. It's no longer the store of value that it once was. We can't rely on the American printing presses not firing up in the years ahead, particularly with all those unfunded deficits and that debt pile that just continues to grow. I think that's part of the problem. The other part of the problem is, and one of the driving factors for gold, is de-dollarization is real. And the world has seen, what happened when the US froze Russia out of the US dollar system. That'll happen pretty quickly. As Muhammad Al-Arian said, and he's a well-regarded economist, certainly one that I follow closely, wrote a big article about it this week in the Financial Times, and he says that it's the fact that all these countries are learning how to put infrastructure and pipes around the US dollar system, and it's eating away at the dollar's reserve currency status. There's an old saying that I had a saying I was going to say, but it's like the proverbial tipping point. Something's not that obvious until it is, and we might see the US dollar sort of retain this sort of permanent resilience, and that it's going to be around forever as the world's reserve currency until the day that it isn't. The straw that breaks the camel's back. I don't know what it's going to be, but the fact that the gold price has moved higher, defied gravity, breaking free of these historical inverse relationships with the dollar and the bond market is significant. And I think if anything, we're going to see this bull market accelerate next year.
And we spoke a little bit about, just recently we spoke about the Aussie dollar gold price, and you spoke about, some of these gold producers here in Australia printing money. Well, look at what this one's doing.
Yeah, it's a Northern Star. It's one of the leaders in the Aussie sector. It's obviously paving the way for the other gold miners. It's broken out to record highs, but it's one of the few. There's not a lot of the gold stocks have not got back to those 2020 highs, and which in many cases for a lot of them were record highs. So I think this chart really illustrates not just the fact that Northern Star can continue to extend higher now that that record high has been taken out from 2020, but I think this points to other gold stocks following in the footsteps of Northern Star.
Okay, and another Aussie gold stock I know that you've been very bullish on.
Yeah, well, it's still roughly a third down from those 2020 record highs. So I just really wanted to put this chart up just to show a lot of the members that you haven't missed the boat. There's still been a lot of stocks out there that haven't really done much. Sure, Evolution's had a big move between 22 and today. lifting sort of 150% off those lows. But look where it was back in 2020, and look where it is today. You know, it's still 30% down from that peak. So, you know, obviously, you know, we think gold and copper prices are headed higher, and that will benefit Evolution. It's a diversified producer, so you know, I'd be worried if the stock didn't get back to retesting those record highs, you know, in the months ahead.
Now on to silver. I mean, I know this is something you and I have spoken about quite a bit. Are you still bullish on the silver?
I am indeed. And, you know, one of the big things missing from the bull market and precious metals was, of course, the fact that the other precious metals weren't actually behaving like gold. You know, gold was doing all the heavy lifting out of the PGMs. Gold's been the one making the new highs, and, you know, silver wasn't doing much. Platinum wasn't doing much. Palladium wasn't doing much. Well, silver has awoken from a slumbering bear market, in my opinion, this year. And, you know, since we saw that breakout, which I wrote a lot about, that converging triangle earlier this year, characterized by those blue lines, we've seen the silver spot price successfully test that breakout level and forge higher. I've been encouraged by the fact that it's pushed apart past and above those historic highs. And, you know, I think scope is now open for a retest and a run towards that $48.50 high that we saw back in 2011. I think that's where it's headed in the years ahead. And who knows, Pat, we might even see it get back to where it got to when you know, the bunker hunts tried to corner the market back in the 80s.
Well, that'd be interesting if we saw it get back up to that level. And I thought we'd pop this chart up now because I know this is a stock that you like as well.
Yeah, we hold Fresnillo in all our portfolios. Look, this is a great chart, you know, and I think I really wanted to put this up because, you know, we do get a lot of inbound inquiry from some of the members saying, oh, you know, that we've missed the gold rally, we've missed this, we've missed that. Well, you haven't, and there's plenty of stocks that can do well, I think, in this precious metal bear market. Bull market. Let's look at Fresnillo. You know, this big picture, 10-year monthly chart, big primary downtrend, big bear market. We've only seen Fresnillo exit that bear market and push above that primary downtrend in recent weeks. Big breakout from sort of 600p, big resistance level, and we've seen it run to nearly £8. I think, like, near term, we might see some backing and filling in consolidation, but Fresnillo is one silver producer that I think has a significant amount of recovery potential in the years ahead. And we hold this in all our portfolios, including our in-house account.
Palladium, what do you think of this at the moment?
Well, we've had silver confirmed the bull market in precious metals. It's finally now following and indeed actually outperforming gold. I think platinum is poised for a significant breakout. And as we've seen, you know, with the Hong Kong and China benchmarks last month, you know, a big multi-year bear market, in this case, it's multi-decades. It's 2 decades in the making. Bear markets never end quietly. They especially an extended bear market like this. So there's a breakout. In my opinion, there's a big breakout coming. You know, we're seeing that primary downtrend pressured. We've seen a series of higher reaction lows. We can see that the spot price for platinum is coiling up within this converging triangle. You know, this says to me that we're going to get a breakout. And, you know, my experience tells me that when this breakout comes, it could be quite powerful. I don't know what the catalyst will be. I have no idea. I mean, it could be anything. It could be, I just don't know. We just don't know. But technically, this market looks like it's ready for a substantial move higher.
And this is one way to play it?
Well, Impala Platinum is one of the world's larger platinum producers. Most of the platinum is produced in South Africa, and that's where Impala that they have their mining operations. And we can see, like the platinum price, and as you'd expect, the price is well down. It's pretty depressed. It's only really just sort of got above $6 US. This is the ADR that's listed in the US. So yeah, I think, if I'm right on platinum breaking out, then we should see a decent recovery in Impala Platinum ADRs that are listed in the United States.
Okay, well, that concludes the formal part of the presentation, and now we'll get into some of the questions. Got a question here from a member, like, what percentage weighting of gold should you have in your portfolio?
Look, we don't, as you know, Pat, we don't give advice to members on it, how to allocate within their portfolios, because everyone's got different risk tolerances. One allocation to someone who's elderly and risk averse might be very different to someone who's younger. So it's really up for the members to understand. But as always, don't bet the house on it. It never pays to put everything on one sector or one stock. You've got to be diversified. But it really sort of comes down to what your own risk tolerances are. We've got a significant chunk of exposure to precious metal stocks and the Fat Profits Contrarian Fund, and we're comfortable with that sort of risk framework. I've got a significant amount of exposure personally, but it really comes down to your individual risk tolerances. And just remember, there are no guarantees in life except death and taxes. We like to think that we have a strong conviction and a good idea about a market or a stock and the way it's going to go, but there are absolutely no guarantees around that. So risk tolerances, allocations, it really comes down to the individual. And if you're unsure about that, then perhaps you probably need some advice.
Okay, and I don't want to get into a political conversation here, but a couple questions here about what could happen to the US dollar if a certain individual wins the election. Do you think there'll be...
The way the market internals are moving at the moment, they're pricing in a Trump victory. If you look at the polling, I think this morning I was listening, Bloomberg, I think Trump's polling at around just in the high 50s versus Kamala Harris in the low to mid 40s. Who knows how the election's going to go? It could be a Trump win, but the Democrats might control Congress, or it might be a Harris win with the Republicans controlling Congress. So there might be some gridlock. We just don't know how it's all going to go. But the way the markets are behaving and pricing, it says to me that there's going to be a Trump win. I think if Trump does win, it could be inflationary for the US, particularly if he imposes all those tariffs. All that will really result in this higher domestic cost for many different goods that are currently being imported from China. It's going to take years for a lot of that reshoring to take place. So yeah, I think look, under Trump, probably more inflation, higher tariffs. We'll see larger fiscal deficits and greater fiscal spending. He's going to put in tax cuts. That's going to put upward pressure on the deficit. So I think this is going to have negative consequences for the US dollar next year. And whilst the bond market might be rising, and that might be providing, bond yields might be rising in the US because there's going to be a lot more treasury bond issuance next year. regardless of who wins. You know, I think, and that's providing a bit of a, rising bond yields are providing a bit of a tailwind for the greenback. I think this is going to prove to be quite short-lived. And then the chickens start coming home to roost next year when, you know, the markets really start getting focused on the deteriorating financial fundamentals of the United States. You know, $2 trillion deficits, 35, 36, $37 trillion national debt, rising unfunded Medicare costs, and an increased interest cost burden, which is now bigger than the US military for the first time ever. You know, in other words, the US is now spending more on servicing its debt than on the military. That's a new record. I think, you know, the chickens come home to roost on this front. So I guess the message I really want to make is, regardless of who wins in November, that doesn't really change our thesis on, you know, precious metals, etc., or our long-term prognosis for the US bond market. And if I had to put a bet down today, I'd probably betting that the Republicans will get up. It's just hard to say whether it's a clean sweep or whether there's going to be a bit of gridlock. A gridlock would probably be quite good. But yeah, so there we go. That's my take on it, Pat.
Okay, and as you brought up having a bet, what's your bet on Melbourne Cup Day in relation to the rate decision?
Oh, look, I think the RBA won't cut. I was gobsmacked at how strong the labour market is. The unemployment rate, you know, it's just too. The labour market in this country is just in Australia, it's just too tight. It doesn't give them really the ability to move, and so it's the mirror image of what's happened in the US. You know, those jobs that have been created, it just points to a very strong underlying economy. And although I think, you know, the Australian economy is bifurcated, in that consumers are not feeling great. The consumer spending's been under pressure at the discretionary level. We've seen certain sectors really underperform. You know, we're seeing that labour market hold up. So I don't think they cut in November, but I would not rule out the first one going in December, particularly if we have that downward inflationary trend confirmed, and, you know, even a modest amount of let up in the pace of hiring that's been going on at the moment.
Okay, well, that will conclude the session today. Angus, thanks again for today. We hope all the members enjoyed today's presentation, and thank you for joining us, and we'll say bye for now.
Bye for now, Pat, and bye to all our members.